Welcome to Strategy Saturday. I'm Charles Carillo, and today we're going to be discussing what is carried interest. Have you always wanted to invest in real estate but didn't have the time, didn't know where to find the deals, couldn't get the funding, and didn't want tenants calling you? Since 2006, I've been buying income-producing properties in great locations that provide us with consistent passive income while we wait for appreciation in the future and take advantage of tax laws while we're waiting. And unlike your financial advisor, we invest alongside our investors in every property we purchase. Check out investwithharborside.com. If you like the idea of investing in real estate, if you like the idea of passive income, partner with us at investwithharborside.com. That's investwithharborside.com. Carried interest, commonly referred to as carry, is a share in profits that general partners receive in compensation for the management of a private equity deal or fund, like a real estate syndication. The origin of carried interest can be traced back to the 16th century, when European ships, mainly Venetian ships, were crossing to Asia and the Americas. The captain of the ship would take a 20% share of the profit from the carried goods to pay for the transport and the risk of sailing over oceans, while the investors took 80%. So how does carried interest affect real estate investors? Well, when investing into a real estate syndication, there are general partners and limited partners or investors. Most deals are set up as an 80-20, with 80% going to the limited partners, above any preferred return, usually 7 or 8%, and 20% going to the general partners. The 20% paid to the general partners is a performance fee, and it directly aligns the general partner's compensation with the performance of the asset or the fund, which is exactly what you want as a passive investor. So why is carried interest so controversial? Well, every once in a while, you will hear in the news about carried interest or the carried interest loophole. Private equity investment managers earn the majority of their compensation from performance fees, the 20%, the carry. If the assets are owned for 3 or more years, the performance fee compensation or carried interest is taxed at capital gains rate, which is a maximum rate of 20%, compared with the top ordinary income rate, which is taxed at 37%. Now, is carried interest good or bad? Well, carried interest incentivizes investment in the U.S. economy along with taking huge risks. As a passive investor in real estate syndication or other private equity investment, the 20% performance fee is paid out only after limited partners receive their preferred return. As a passive investor myself, I believe carried interest provides an additional incentive to the general partners subsidized by the government. The 20% really is 25 or 30% if it was taxed at ordinary income, while passive investors still receive their preferred return and their 80%. Now, carried interest is an indirect benefit of investing into passive real estate syndications. So I hope you enjoyed. Please remember to rate, review, subscribe, submit comments and potential show topics at globalinvestorspodcast.com. Look forward to 2 more episodes next week. See you then.
Nothing in this episode should be considered specific, personal, or professional advice. Any investment opportunities mentioned on this podcast are limited to accredited investors. Any investments will only be made with proper disclosure, subscription documentation, and are subject to all applicable laws. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Syndication Superstars, LLC exclusively.